Today I'm here meeting with my buddy Robert. We're going to put on some trades on tradediff.com. So if you want to go ahead and share your screen, Robert, and I'll kind of talk you through some trades.
All right.
All right.
Let's get all these games and random stuff out of the way. Go for it.
Okay. All right. So there we are. You've already pulled up a chain. Are you looking at putting on a trade on DraftKings?
I was just looking at it.
Okay. Well, have you decided on anything that you are bullish or bearish on at the moment?
I was bearish on them in the next
bearish on DraftKings. So do you want me to maybe coach you through an example of a bearish trade?
That works.
And why don't we do two different types of bearish trades?
Okay.
And then I'll show you how to set up groups and then create some groups. And then you can put them into groups, these two different groups, and you kind of get an idea of how each group performs. Because my desired result is at the end of these 30 days that you've traded 5 or 6 different types of trades, so that in the future, if you have a bullish, bearish, or neutral kind of belief about something, that you know how to put on that kind of trade.
Sounds good.
Right. So let's start off with the first bearish trade by selling a naked call out of the money. So let me see what DraftKings is currently trading at. And I also do not know what the liquidity of DraftKings is. It's not too bad. So let's look at August. And how bearish are you?
Like between, what are usually the ranges? I mean,
well, here's a way of answering that. If it went up, how high could it go up, do you think?
Maybe back to like 36.
Okay, so let's look. 36 you think might be the peak of what you think it might hit?
Mm-hmm.
All right, so why don't we sell it's kind of an aggressive, so we'll sell a 36 call. Now what it'll mean is if it goes to 36, you would have to take a short position on DraftKings. So now for the contest, you're not actually having to do that, but I'm kind of trying to train you kind of to think the way you would think in real life. And would you be prepared to take a short position at 36 if it goes to 36?
Yes, I would.
Well, let me ask you, and I don't mean to insult you, but do you kind of understand what a short position is?
Yeah, I do. I mean, wouldn't it be less, like the variance would be lower if I went like a little bit higher, like let's say like 38, 39 or something like that?
Yeah, it would. It's more like it's a higher probability that it won't get there and you'll just keep the premium.
Yeah.
So it's kind of a risk reward. You're going to collect more money by getting closer to the strike, but it's a higher probability of profit if you get further away.
Okay.
So we're kind of making that. And the cool thing about some of this stuff is you can be wrong and still make money if it doesn't go too far past your strike. So right now, the 36, you could sell it for about $3. Mm-hmm. So if you did one contract, you're collecting $300 and you're basically betting that it's not going to go above 36.
Okay.
On one contract. If you did 10 contracts, you're collecting $3,000. Mm-hmm. And maybe it's worth me doing a 30-second description of what a short is in case there's anybody else who's watching this video who's not quite sure what a short is. It's kind of like I borrow your wheelbarrow and I sell it. And then at some point in the future, I have to buy another wheelbarrow and replace your wheelbarrow. They look exactly alike. You couldn't tell the difference. It's just a generic wheelbarrow. So what I'm hoping to do is to sell your wheelbarrow at today's prices, and then the price goes on sale somewhere else, and then I go buy that wheelbarrow at a cheaper price and replace your wheelbarrow. So essentially that's what you're doing is you're borrowing stock, you're selling it today, And in the future, you have to replace that stock that you borrowed from someone. And that's essentially what you're doing on a short sell. All right, so if you go further out, if we went to 37, you'd collect roughly 260. If you go to 38, you'd collect roughly 225.
And you're looking at just on like
I'm looking at it on Thinkorswim just because I can get there faster. And so roughly, if you're looking at the 38s, there's almost a 70% probability that it's not going to get there, which means you've got a 30% chance of just keeping the, you've got a 70% chance of just keeping the premium.
Okay.
And say, thank you very much. We'll see you again next month. Right?
Yep.
So, what do you think? If I was just in the pattern of finding a lot of opportunities, I'd probably go a little bit further out. I might even go to 38.
Okay. Yeah, that sounds about right.
So why don't you sell the 38 call at about 210? And, depending upon, you have 100,000 to play with. I'd do as many as 5 contracts.
Okay.
So why don't you go ahead and click on that 38 call. And if you hover over it, you can, the put, the bid and the ask, you can see if one of them says buy and one of them says sell. And since you're in the selling contest, we're going to be selling that premium.
Okay. So
put your clicker in the middle of that and then kind of scroll down. If you have a wheel on your mouse, if you don't, you can use that thing there. Okay. So you're not buying, you're selling the 38 calls.
So let me see here.
There you go. That 245 there, and click on that. And then see your plus and minus on that orange thing to the left of that red thing there. So you can click that up to say maybe 5 contracts. You could go more than that if you wanted to. And then when you're ready, so you're collecting about $31.50 in theta decay. Mm-hmm. And essentially what that is, you can think of it kind of like rent money. If you had a renter that rented your place for $1,000 a month, roughly they'd be paying $33.33 a day in theta decay.
Okay.
So that's kind of what we're getting paid for signing up for this risk. Somebody else is offloading that risk. You're selling insurance. They're buying insurance.
Okay.
Somewhere out there is somebody like Mo that's going, I'm going to guess that DraftKings is going to go to the moon. So I'm going to buy a 38 call in August because I'm bullish. And I think it's going to go to the moon, and that'll allow me to come in and buy at 38 and sell at 1,000 because I'm a gambler.
Okay.
You're like, I'll take the other side of that trade, right?
Mm-hmm.
So you're taking it. For every buyer, there's a seller. So you can go ahead and click submit on that. And then if you want to make sure, okay, you see it went through immediately. That's good. So any other bullish or bearish trades you want to put on?
I would say like Google.
Okay, you want to go bullish or bearish on Google?
I'm going to go bullish.
Go bullish on Google. So what we're going to do is we're going to set up, because Google is such a big underlying, it trades at 1522. Mm-hmm. Why don't we, in August, why don't we buy the 1500 call and sell the 1600 call in August? And I'll do a risk graph on that while you kind of start to set it up. And I'll show you kind of what that risk graph looks like before you end up buying it.
And then can you go for what you kind of just said, just to...
You buy a 15 in August, you're buying a 1500 call, mm-hmm. and you're selling a 1600 call.
Okay.
And let me just do this for one contract, and I'll show you kind of what the risk graph looks like for that. And if you want, I'll stop sharing your screen and I'll show you mine. So I'll stop your screen share here, and then I'll share my screen. Okay, so Google is currently trading at 1521. So here's basically the risk graph for this. So here's today's price at 1521. So the purple line is today's date. The green line is the date of expiration. So at some point in the future, you may be using the Thinkorswim platform, and that's what this is.
Mm-hmm.
So what you do is you want to make sure that this is today's date. It's not. It says July 26th, so I'm going to crank it up to the 29th. And this is the date of the expiration of your option that you're selling. In this case, it's August 21st. So we've got it set for August 22nd. So what this shows you is if as it goes up, your maximum win starts when you hit 1609, and you'll make on one contract, if it gets there by August 22nd, you would make $5,840 on one contract. And this trade would actually cost you $4,161, which is your maximum loss.
Okay.
So I'm going to show you kind of what the probabilities of profit are at expiration, just so in case you're curious. So it looks like on this trade, your maximum win, your probability of profit is about 49%. So it's kind of a coin flip. There are some other trades that I like to do that give you a higher probability of profit. Let's see what it looks like if we bought the 1550. Your probability of profit actually goes down. So well, I still like it. It's still a bit of a coin flip, but if you're bullish and you're right on the direction here, you can make $5,800 in a month, and all it has to do is go to 1612 or higher. You start losing money if it goes below 1543.
Okay. And will TradeDiff be able to let me know like at what point I'll start losing money?
It will. You can see it's a daily updated, and when you start every day, you'll kind of see what your P&L is for that day.
Okay.
And you could monitor it. So I think it's going to be educational here too. Now let's just out of curiosity, see if you lump this into September, what it would look like. So you're buying the September 15 and you're selling, let's delete this whole trade and just look at what it is if I buy the September, and this is also called a poor man's covered call. So you're buying something that's in the money at 1500. 1500 call. We may not be able to afford this one given our parameters of our contest, which only allows you to put, I think it does allow you to put up to 10% in any one thing. So let's see what this does. Selling the 1600. It still has this last trade on.
And how long have you been using this platform,
Thinkorswim?
Thinkorswim.
Probably 15 years.
Really?
Yeah. It is like one of the most popular for options traders. In a way, it's like flying a 747. There's a lot of features on here that you won't use all of them. But there's enough to keep you busy for the next 15 years learning the features that you want to learn. But you don't have to know everything about all of the bells and whistles on this guy. All right, so let me crank this down to one contract, and then we'll look at a risk graph on this one. And this just means you're buying the one in September and you're selling the one in August. So we'll analyze this trade. So this one, you start making money above 15.14. So it's slightly $4 less than it is today. Your maximum win is 54.03. And the cool thing about this is in August, you could resell to September again. So let me see if I can give you an analogy. You've got you're subleasing a house and you're able to sell it for 2 months, rent it out for 2 months because your sublease is for 2 months.
Mm-hmm.
So our first rental is for August, and then we could rent it again in September. So even if it goes against you, you could sell another premium and possibly still make a profit.
Okay, just kind of like doubling down almost.
Yeah, kind of like that. So why don't we do that? Why don't we buy the 1500 in September and sell the 1600 call in August? And I'm going to stop a screen share here. Just to let you maybe see your screen a little bit better.
Okay,
and if you want, you could share your screen if you need any help.
Yeah, let's do that.
All right, you're going to go into, so you've got weeklies and monthlies, and we're going to trade the monthlies in August. So there's 23 days to expiration. And so we're going to buy, first we're going to sell the 1600 call. Now, if you were trading a lot, I always like to have a mouse that has a scroll button on it. That way you don't ever have, you can just use your scroller and scroll down, and it just saves you a few seconds, which if you add that up to 1 million of these that you're doing, it helps you.
So going down
if you put your, okay. I'm trying to train you if you were to use a mouse scroll. Yeah. Okay. All right. So and I'm watching you. I'm watching you and realizing how difficult it is if a person doesn't. So you go down to 1600 and you're selling the 1600 call. Now you're going to get a warning screen here, but that's okay because it doesn't know that you're putting on another leg yet. So click on that. See how that warning says margin of 17,607. All right, so now go into the 1500 call in September.
This would be the next September.
And buy that guy. The other one on the ask side. See that says sell. So go to the ask where it says buy and click on that. All right, wait a second, because you must have clicked it twice, did you?
I did.
All right, so now you've the 1600 call. Okay, the 1500 You're buying the 1500 call in September. Okay, There we go. All right, so I think you're selling the 1600, you're buying the 1500. Your daily theta decay is $25.90. So go ahead and click on submit. All right, so now you are 9% allocated. I think over this week, I'd like to see you at some point of having like at least a 30% allocated.
Okay.
You want any other ideas of trades, or at least you know
how to do it?
All right, let me teach you how to set up groups. All right, see that icon? You can go ahead and share your screen again if you want, and see that cog next to trade at the top. If you click on that and then click on the word portfolio right there, yeah, and then scroll down until you see something that says new group. See right underneath stocks, there's something written. So don't click in that box and type in the word naked puts, and then create new group. And then naked calls, make a new group called naked calls. And then create a new group, and then put poor man's covered calls. And create that group, and then put poor man's covered puts. And then create that group, and then create a group called straddle/strangles. You create that group. Okay, then scroll back up to the top and see where it says Robert Shu's simulation portfolio underlined. Just click on that. That takes you back to your portfolio. So what we did with DraftKings is we sold a naked call. So click on those three dots next to DraftKings, down underneath your options, and then you see something there that says naked calls. Click on that. See, so now, and then click on Google and select poor man's covered calls. Okay, see how it put them into those two groups? Mm-hmm. The reason we're doing that is you can watch each group after you populate it with 2 or 3 things and get an idea of how that category performs. And you could click on a graph to see how your results are doing over the and it's daily compiles your results over the next 45 days. So imagine, if you will, you've kept this record in a real account for a year, 2 years. You know, you can see how a particular category is performing, and then decide if you want to do more or less of that.
Okay.
All right. Anything else that you can think of, bullish or bearish? Either you froze or you're in deep thought. I think you froze for a second. I was like, Robert is either very good at holding a pose for a long period of time, or he froze for a second. Any other bullish or bearish that you can think of?
What about Carnival, I guess?
Carnival Cruise Line?
Yeah.
CCL, bullish or bearish?
Slightly, I guess in the long term, kind of bullish.
Okay.
But I guess for this representation, like, how would you, like, options are usually done in the short term or long term? You can do long term as well.
Either one. You can do it. The strength of options is its flexibility. So you can do nearly anything you can imagine. You could trade them neutrally, bullish, bearish, or neutral. So if you're undecided about CCL, we could create something that's neutral to bearish or neutral to bullish.
Okay.
Like it's skewed, right?
Yeah,
Skewed
yeah,
slightly
yeah.
bullish or skewed slightly bearish, but you'll also make money if it's unchanged.
Huh.
So,
So like I guess my idea is that, you know, in half a year to a year, I consider them slightly bullish to bullish.
in half a year to a year, you consider them. So at what point would you start your bullish
I mean, I guess to be on the
presuppositions? So if you were, like, for example, you could say, I think they're just going to stay about the same until this point in time. And at this point in time, they're going to start becoming bullish. And so, so you could theoretically trade it neutrally. Let's say you believed it was just going to be stagnant for a couple months.
Mhm.
You could trade it neutrally. Then you could switch to bullish in 2 months.
Okay.
So, I mean, that's kind of, but I don't.
How would you make money? How would you make money off of it being neutral?
That's why I'm here. That's what I hope to just excite you when I show you. So why don't let me set up a neutral trade on Royal Caribbean. And if you want, are you slightly bullish? Neutral to slightly bullish? If so, I can skew it so it makes a little more money if it goes up, but it also makes money if it's unchanged.
How about
That's called
actually
a skewed strangle.
a skewed strangle?
Strangle. So why don't let's create a strangle on CCL, and maybe you want to put it in and just so why don't I share my screen and then I'll show you. So what it's like is, imagine, if you will, we were kind of betting on sports and we had like how they bet the over under. So you got a kind of a high point and a low point, and you were picking a range. And as long as the total point stayed within that range, you could make money. And I'm putting it into a sports betting analogy because, sometimes people don't bet sports or aren't gamblers. Like, I don't know what that would look like. So are you seeing my Thinkorswim platform? All right. This is CCL. It's trading at $14.26. Out of curiosity, I'm going to scroll down and see what its implied volatility is. It's pretty high. So that means you're going to get paid. When volatility is high, the premiums and options are higher. So you get paid more. So it's kind of like, if a hurricane has been projected to head towards Miami, and you got a house in Miami, what do you think the price of insurance is going to be if you don't have insurance?
It's going to go up pretty high.
Yeah, really high. So, when there's blood in the streets, when there's a lot of fear, you get paid for option premiums. So let's take a look at August, and we're going to sell both a put and a call on Carnival Cruise Lines. So let's look at this, and I'm going to sell the 13 Delta here. Just we'll see what the risk graph looks like. Sell that guy, and I'll look down here at a Delta that's close to 13, and right there is one. And so it's a low price stock. So assuming I did 10 contracts on this, I could collect $420, and that would plop into my account immediately. And what I'm looking at here is, here's the risk graph, and I'm going to pull this guy over here, spread this out so it's a little better view.
And are you just pulling the two trades, or what are you?
What I'm doing is I am analyzing this particular trade, that if I was to put it on, what it would look like.
Okay.
So this trade has a 67.51% probability of profit. If you're playing Omaha and you knew the numbers and you knew you had a 67.51% probability of profit and it's your turn to bet, what would you do?
Of course, just try to get it in.
You'd say, well, you can. It's a pot limit. So Jared would say, nice try, Robert, but this is a pot limit game. You'd bet the pot, right?
Yeah.
So here's basically it shows you. So CCL is currently trading at $14.27. Here we are today. So your maximum win on this, actually I had some other trades on, so this is going to change our percentage here. This trade has a 76% probability of profit. Your maximum win is $420. You start losing if Carnival goes below 11.09, and you start losing if it goes above $19.41 by August 21st, which is just 22 days from now.
And let me ask you something. Like, let's say
Okay.
it starts veering towards 11, 10, 9. Is there a way to offset those losses or get out of the option?
Yes.
Okay.
And I'm just going to say how you do it, which is going to be confusing to you because option trading when you're a newbie sounds like a foreign language. And so then you got to back up and you got to define what certain terms mean. So in a nutshell, if it goes against you, you roll down the untested side.
Okay.
So if it's going down, it's testing your put side.
Yep.
So you roll down the untested side. In this case, it would be the call. You turn a strangle into a straddle. A straddle is when you sell both a put and a call at the money. In this case, a strangle is where you sell a put and a call both out of the money. It's on video. You can go back and watch it. You can go on Collaborate. You can ask me questions later as you try to kind of digest this. And I know at times it feels like you're drinking through a fire hose, but my goal is at the end of 30 days, you'll be able to digest a little bit, and by the time you get to 45 days, you'll be, like a foreign language, you'll be able to say, where's the bathroom? And yeah, you'll accidentally say, I love your grandmother very intimately, and you meant to say, pass the sugar.
Right.
Because you used the wrong intonation or something. All right. So, yeah. I was about to tell you a story, but I remembered it was being videoed, so I probably shouldn't go on public record for that one. All right.
Another one of those Dale stories.
Yeah, there you go. So I think you can afford 10 contracts on this, frankly, because in an account size of 100,000 that you're trading in your paper trader, you could afford to take possession of this 1,000 shares at a price of $11.50, and it wouldn't kill you.
Mm-hmm.
That's always the way I think about these kind of risk things, right?
Yeah.
How bad would it be? What's the worst thing that could happen, and how bad would that be? So when you're selling a strangle, if it goes down to $11.50, you'd have to buy 1,000 shares at $11.50. In this case, if it went to 19, you'd have to be short Carnival at 19.
Okay.
Those are the consequences. So why don't you go ahead and put that trade on if you like it? And I'll stop the shares, which might make it easier.
You're going to, well, let's just have you share the screen first. Make sure I'm not doing anything crazy.
Okay. So once again, we're selling the 1150 put, and all of them are in August. We'll sell on the 1150 put. Other side, that's calls. That's
Selling.
your calls are on the left, puts are on the right. So you just, this is called a fat-fingered mistake. So just hit the red X and erase that because you're on the call side.
Okay.
All right, so the right side is the puts. So, yep, you're selling the 1150, right? Sell that guy, click on that, and then go to the 19 strike calls.
19 strike calls.
Yep. Yep, you just clicked on buy.
Oops.
You want to sell. And dummy proof it as you hover over the top of the, one of them says buy and one of them says sell.
So
And
we're
this-
trying to sell the 19.
Yeah, see that one says buy, that one says sell. See that pop-up screen there?
Yeah.
That's to help dummy proof it. So sell. Anytime you're selling, they're going to both be red. Anytime you're buying, they're both be. As a good kind of thing is, you know, the carpenter's rule. Measure twice, cut once. So what you do is you just do a quick audit of what you're doing before you click submit. So if you go over to that yellow plus and minus right above your two trades and click on that plus, why don't you make it 10 contracts? Okay. And then go ahead and submit that trade. All right. So then scroll down under options to CCL to the three dots next to it and put this one into straddles strangles. Okay. So now you've put on, you've sold one naked call. You've created a poor man's covered call, which is bullish. You've created a straddle strangle, which is neutral. So you've put on one bearish trade, one bullish trade, and one neutral trade.
Cool.
So you're well on your way, buddy. And you're 14% allocated.
Just barely on my way.
Yeah. So what questions do you have so far?
No, I just need to do my research and figure out what it is I'm doing.
All right. Well, what you can do is we could say we're done for today if you want.
Sure.
Or I could demonstrate some other features of trade diff to you that you could consider at some point you might consider using.
Sure, let's do that.
All right.
What are you?
All right. So one of the things I think is cool is snapshots. So what you can do at any time in your contest portfolio, you could create a snapshot. So I've created a snapshot here. You know, I can create a new snapshot at a point in time, and then I'll view that snapshot. So this is everything in my contest portfolio at this time. And I can do this in my real accounts too. So then I can come up here and I can add a note. You know, I could go here, I could highlight this Disney trade, and then I could add a note about that Disney trade. Hey, check out this trade that I made in Disney, right? Submit it. Somebody else can then come in and make a comment on it. I could take this URL, go to the leaderboard for this contest we're in. I could put that in Collaborate so other people could see that snapshot. So all people would have to do once they see in the Collaborate, they click on it, they immediately see my highlighted trade, the comment I made or the question about I made on it, and then they could make a comment. So it then creates a collaborative environment where we're learning from other people's trades, et cetera. And you could write a comment, hey Dale, how did you pick the strikes? Right, and I could then explain it. So it's a way, it's been said that it takes about 10,000 hours of deep and deliberate practice to become world class at anything. And I think what we've attempted to do is to create something here that instead of taking 10,000 hours, it could maybe take 100, because you're learning from other people's mistakes.
Correct.
You're trying it out yourself in a way that if you make a fat finger mistake, it doesn't, like I was talking to Quan, and he said he learned how to play poker by, he spent $12,000 playing 1-2 limit, and I was like, how much could you have saved if you just had somebody to tell you what hands to play in the beginning? Or, so a few simple coaching could have possibly turned that 12,000 into 2,000, maybe.
Yeah.
What it cost him. The school of hard knocks sometimes can be expensive, and it can be expensive here too. And so that's just our vision.
Okay. To build a community, basically.
To build a community around a singular purpose of becoming kind of a do-it-yourself trader. And I think it builds a life skill that instead of having to pay somebody else up to potentially 1 to 5% annually for the rest of your life to do it for you, people could do it themselves in the same amount of time it takes every day to mow your lawn once a week. If your purpose was scarcity of time.
Correct.
I spend a lot more time in it because I enjoy the activity itself. Mm-hmm. So I've got 12 accounts that I trade. Now, 20 other people that are either learning how to do it or at different stages of doing it, right? I got a passion for it, right? So that's kind of one thing, is the snapshots. The second cool thing I'll show you is, the graphing capabilities. So, here's an account. This is actually my real account, but I can graph its performance. So I can go up here to trends and look at kind of an ROI, right? I can look and compare what my fund is doing against NASDAQ and against the SPY. Okay. So it enables me, during Hurricane Katrina, there was a football game and the scoreboard was blown down and the fans came and nobody was even paying attention because there was no scoreboard. And what they realized was you got to measure the results of what you're doing. Otherwise the game isn't any fun. So the idea is you got to kind of see what winning looks like. So what we've tried to do is to create kind of a dashboard to measure your results, see how you're doing. I know one time I kept a measure of straddles and strangles on an Excel spreadsheet, and I bet I spent 30 minutes a day on it for a year to see if this was a strategy I wanted to continue doing. Had I had TradeDiff with an API connection to my real account, I could have set that up and measured the results of it faster and instantly and automated. So it's a time saver for people so you can put this at any time period here. You can also take your current performance and project it into the future. So you can go on to analytics and do some ROI projections. So this is only since June 15th. So you can see June performance. You can see July's performance. Now, this is not really representative because it's short term, but for a person who's done this for a while, I think the motivation for people, especially young people, is just to see, they may think, all I've got is $10,000. But when you see what $10,000, if you're able to generate 10%, 15%, 25% annualized, when you can see what 10,000 can turn into over a 20-year period, it tends to get people's attention. Have you ever heard of the rule of 72?
Yeah, I have. Okay.
So 72 divided by whatever return you can get is how many years it takes your money to double. So it's kind of,
indicative of how to plan your future.
Yeah. So 72 divided by 10, roughly your money doubles every 7 years. So if you've got 35 years, before you're going to retire, it's going to double 5
5x.
times, right? So a person that started out with $25,000, 50, 100, 200, 400, $800,000 for starting out at 25,000. So 1988, I saved half my salary and was started with $10,000. So that's kind of my own rule of 72 story. That it seems like maybe a small amount when people are started, but you start with what you got.
Yeah.
So that's kind of a cool feature. We're always adding different metrics. There is a metric called percent of in it, and that's the percent of the initial amount that you've currently captured so far. So for example, if I go in here into the contest, I'll show you some of the strangles. And the reason percent of in it, Mike used to work for Google, and he would have maybe 30 minutes a day when he could trade. And so he really needed some tools that could help him identify what he needed to do in that 30 minutes, right? Mm. So here's our spread contest. So let me go to my account there, and I've put things into some categories. So here's straddle strangles. See over here in this category that says percent of in it? Mm-hmm. That's the percent of the initial credit that I've received that I've currently captured. Tasty Trade recommends closing strangles at 50% of max value. So this Macy's, if I collected $300 on Macy's, I'd want to close it when I've captured about half of that, or $150. And the reason is, I have two analogies there for why they like to do it. First is, if you owned a convenience store, you would want inventory to turn over. So that's one metric that businesses use, is inventory turnover. So imagine that this is a lemon and I'm squeezing 50% of the juice out of it. So now I could spend more time squeezing the other 50% of it, or I could grab another lemon and start squeezing on that one. And so they've done some back testing, and they believe that it helps you to improve your daily win rates and also lower your down swings and manage risk if you close strangles at 50% of max value. And so that's a principle that I try to apply. But if I manually was to go through the 12 accounts and all the strangles I do, that would take a lot of time. But I can merely pull them up and look at this percent of in it. And as soon as it gets down to 50%, it changes color so that I can immediately go to it, which tells me I need to take an action. And so then I can go and start to close that 50% of max value.
Okay.
All right. Hey, you want to see something on SPX?
Yeah, go for it.
All right. So I'm going to go into my real account here, and let's see, I've sold calls and puts, and I've not finished. Let me check here. SPX. I have sold the calls. I've not sold the puts. So I noticed that SPX has kind of taken somewhat of a dip here, and I always want to sell the calls when it's taking a dip. So I'm going to go down here on these puts, and I'm going to look for kind of around the 8 delta put. There's a 9 delta. So I'm going to click sell on this guy, and then I'm going to do a 50-point wide. And so I'm going to go 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, buy. And I'm going to crank this up another nickel. And I'm going to try to do 10, 5 contracts on this guy. All right, I'll click send. Go into monitor. It's close. It's like $1.03. So if I see like a downtick on SPX, it'll probably take it. And then what I always do is I set the max loss on these at 3 times the credit received. And that's just from some back testing of people. See, these groups on Facebook that are geeking out, and they back test these strategies and determine what they think is optimal. And, you know, I've got really 3 sources that I use for that. One of them is Facebook groups. The second is I belong to some Slack groups of people who kind of do this for a living. And networking, I go to some Tasty Trade, Geeks on Parade, and He Said, She Said tours. It's hard to believe that these people actually have a following, but these PhDs travel around the country talking about real technical, geeky topics, math related and finance related. And some of us have had lunch after these He Said, She Said tours. And one of the guys in our contest, I actually met him at one of these luncheons, and I couldn't figure out, we were connected on Facebook and I didn't know how I met him. And because we didn't have any friends in common, right? That's the first place I go, because if I have like poker friends or comedy friends, like what group is this with? And no other common friends. So I finally asked him, I go, how did we meet? He's like, oh, the He Said, She Said tour. We had lunch. I was like, that's it. You know, Glenn Wilkinson, he's in our contest. But that is not executed yet. But had it done that, you know, I'd show you how to set up the stop loss.
Cool.
There. But yeah, I think that's a pretty good start, right? And as you have questions, hit me up. We're going to use the Collaborate tab in the contest. So if you go to you've seen the leaderboard. Have you seen the leaderboard? So you go to get your leaderboard and you click on Collaborate, and that's kind of like a group chat for everybody that's in the contest.
Okay, that's cool. I'm pretty excited.
Yeah, me too, buddy. I'm going to stop recording now, and then we can then I'll tell you that story that I didn't want recorded. All right, guys, thanks for listening. This is Dale, and I'm out, and my buddy Robert. Happy trading.